Investment offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to any results that may be obtained from this. Investing involves risk, including loss of principal, and no strategy assures success or protects against loss. Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Hey everybody, welcome to Vantage Point with True North Wealth Partners. I'm Andy.
Eric Susie.
Number 40.
Number 40, big 4-0.
Crazy.
I know, it goes fast. Happy fall, Thanksgiving.
Yeah, happy Thanksgiving.
Gobble, gobble.
Yeah. Just chilling. What are you doing?
Yeah, well, I'm blessed for one thing. My brother is picking up my aunt this afternoon from Arizona. She's coming in again, so that's cool. He's taking my parents to the doctor's this afternoon because I couldn't. We're doing the podcast, so thanks, Mark. A little shout out there. I helped last week, so now it's his turn. But as far as good news this week for the Thanksgiving dinner cost, so it will be cheaper this year by a little over 4.5% overall Thanksgiving cost. However, food prices have risen 39 months in a row, and they're up 24%, approximately 24% since COVID started. So it's all keep things in perspective. And then Jess, she's putting together all the food. This morning, she just got back from the grocery store. She got the turkey. I said, okay, honey, I'm talking about turkeys today. She laughed. I said, so how much was it? $75. So I forget the exact poundage. It was 15 pounds or whatever, but it was a couple dollars more. So nothing, last year was a real big spike up, she said. This year is called the same or a few dollars more, but overall, just forget it. Food prices in general are still elevated. So
yeah. All right. Yeah, I was reading. There was an article on that about inflation. Because Wall Street has this idea of inflation. It was 3%, spikes up to 9%, right? Comes back down, like the inflation rate.
Yes.
Versus like in real life.
Mm-hmm.
Whereas most people view inflation cumulative, right? Correct. So it's like. So he was saying
it's a compound effect, right?
Yeah, exactly. So it's all like, this whole narrative that inflation is coming down, that we're getting back to normal. It's not even close to being that. So they figure that the prices, that inflation is up from where it was anywhere from 19.3 to 23.5%.
Which is that?
Yeah. I mean, because it makes sense if you think about it, right? You don't go. It's not like inflation's down. McDonald's that Big Mac now
reverse prices.
It's $5 now. No, they don't do that.
Oh, but how about wages? They just $20 an hour. How am I going to pay for that?
Yeah, exactly.
These employers, that's Wall Street for you.
Yeah, so it's just this idea of inflation's down. Well, no, it never goes down.
No,
it's just your dollar.
It's embedded there forever.
Yeah. Yeah, your dollar purchases less.
Yeah.
So anyhow, but it's just that's I don't know if it's marketing or psychology of.
It's called the media.
The perception,
the
perception of some of that. So anyhow, it's crazy.
No, I hear you. No, it's never ending. So I guess some good news, bad news. So the good news, market's been up 3 weeks in a row. Woohoo! Some other good news, based on last podcast, I said, hey, I might be selling a few. And luckily I didn't. So at least we've kept those dogs running a little bit longer. But they're, Andy and I and others, we've kept our portfolios in general on a defensive posture throughout the year. This rolling recession, yes, parts are in it, parts are out of it. But again, it will turn into a more full-blown recession here as we back half, end of the year. But we do have a Santa Claus Rally going on right now.
Yeah.
The show goes on!
Yeah, so even though we have that, pulling a nice little rally here, good news is we have taken over 40% less risk. So our risk adjusted return is less risk than the appropriate benchmark. So we're all about risk adjusted return. We're still hitting solid second bases, and which is key. We have a fact here that came out from the market situation report from Hedgeye. So the holiday Santa Claus Rally, yes, it's upon us right now, but there's little evidence of significant put gamma. Put means going down. Is another all clear sign from the chastened bears, is what they quote.
Yeah, right.
So right now it's just basically, okay, things are, the party goes on slower and lower volume. So volume, you might track that. We're down about almost 14.8. So about almost 15% lower trading volume this year than year over year last year. So again, it's just things aren't, higher highs or met with lower trading volume. So it's just interesting.
Yeah. It is good seeing that. Like I've been telling clients too, showing them, heading this year, more defensive, bond alternatives, the merger arb, dividend stocks, all the stuff that low volatility, all stuff that got, early in the year, right? You had the Magnificent Seven, right, pulling the market up. Exactly. So you had the S&P up 15, whatever, and you got the equal weighting S&Ps like up 2 or 1%.
Exactly.
And so, but when you put that in perspective, you look at like the standard deviation reports that show the volatility. Yeah, it's like we're way back as far as the amount of risk, and actually out like moderate, like a moderate investor actually outperforming, taking on the risk of a conservative right. Portfolio and outperforming moderate Dow Jones moderate benchmark. So
exactly.
So that's been good to see.
Amen. Yeah, no, I'm with you.
Yeah. So anyhow.
No, we're doing the best we can in these crazy times. Not normal.
Changes coming. Sure. Yeah, but yeah.
Changes coming. Exactly.
As far as rebound, we'll do what you got to do.
Exactly. No, I'm with you. Yeah. And another thing, just to touch on some, what's in the news, the latest October CPI print, it came in, down 0.1 or what have you, of percent. So it's at 3.2%. So okay, CPI is 3.2% year over year. Okay, fine. But buried in that within the First Trust / Hedgeye, the healthcare cost is down somehow 34%. In that month. Really? 34%. Okay, right. So it's just how they manipulate things to hit the number they need to hit. You know what I'm saying? It's all narrative. So
that's great. I was just looking at health insurance today.
Yeah. And?
Well, so I could so a $3,000 a month premium. It was a $10,000 deductible.
Oh, jeez.
It's like, wait a second. So that's okay,
$3,000 a month premium. Yeah.
$36,000 a year in premium plus another 46,000 before I get any benefit.
Yeah. No, it's
insane.
It is.
It's got to change.
Amen. No, and then I guess a little bit of good news is that Mayhem Index, used cars prices are down now about 5.3% year over year.
Yeah.
So that's a factor. So that helps. But it equates to now 15 straight months of a decrease on the used car prices. So I know you've been in the business of buying and selling cars here. You're trading horses, right?
That's right. Got dealerships.
This guy, he's driving a nice little truck. He's the man now.
2000 Chevy.
There you go. It's all good. Yeah.
That's right.
So, so it's just interesting how in deflation, you hear Target and Walmart and CEOs talking about that. So people don't quite understand. So deflation, when things are rolling over, decreasing, okay, fine. But what happens is this: deflation is going to hurt companies' profit margins, okay, overall as the economy continues to slow into the first quarter of next year. So it's just a perfect storm, all starting to ebb and flow. So when it all hits at the same time, wasn't your man Brian Westbury from First Trust talking about that? How it's going to sort of hit us from the left side of the field all at once?
Yeah, because the M2, the tightening.
Yeah, I think you're.
Yeah, it's M2, so it's
money supply. Yeah.
Yeah, they got too tight with it, so that's what. Yeah. So we'll see though. See how that
it all shakes out.
Yeah.
So there's just some things that are in the market, and then last on I guess $6 trillion. So you and I've been using a lot of cash alternatives, things like that. So $6 trillion, folks, are in the money market accounts. So that's the most ever since they've been tracking it. So $6 trillion sitting there earning 5%. So why take risk when you can sit back and as the rates are still elevated and high, get that, upper 4s, 5%.
Yeah.
Treasuries and money markets and things like that. So All right. Well, I guess before I spin off, I'll sort of the ERCs, the Employer Retention Credit. Okay, so I've been following this. Really, it's ugly heads reared about 4 or 5 months ago. But Kevin O'Leary from Shark Tank, so he was the guy really promoting all this. And the ERC, it goes approximately $26,000 goes to the employer for every employee. So take that. If you have 20 employees, that's a lot of money. $100,000. Okay, well, that's what really prolonged the summer swoon and when we had that ramp up because all this money started fluxing out into the employer's piggy banks for them to use direct deposit straight in.
So it's free money to the employer.
Free money to the employer.
Employer.
Yes.
Yeah.
Based on how many employees you had. So I have a friend, has a business, took advantage of that. We didn't do it here. So there's some shadiness that goes along with that.
Yeah, my son had a lemonade stand. He got some money.
Nice, exactly.
He drive a Tesla.
Yeah. We should just,
He's 16.
We should do all those little hidden shell businesses that has been doing. Hey, let's just get 26. It's a little what's under the red ball. Let's find it. The shell. But anyways, so that stopped because finally they stopped that the past few months on pause. However, I have a little caveat here to this little, rolling recession / turning into a more, deeper / recession in the Q1. If this switch gets turned back on to ERC in January, if they pass it and turn it back on to juice the economy again, then all bets are off. I'm not going to be in that recessionary camp because we've seen how the impact of how this money and stimulus can keep the markets and everybody feeling good a little bit longer. So think of it as morphine.
Yeah.
Our guy, Brian Westbury, talks about that all the time. A little juice, they juice you up, keep you happy for a little while, but then eventually you will come off of it and then it's not pretty. But until then, so that's a little, I want you to hear that. Again, I mentioned it in the past, but January is going to be key for that. I'm going to be really focusing in on that, the ERC, and that will determine things. All right, what else going on? What's shaking and baking there?
Yeah, no, just looking, end of the year planning.
Yeah,
so,
that's important. Yeah,
Roth conversions where it makes sense. So Trump tax cuts are set to expire
2025, end of 2025.
End of 2025. So so we're doing those qualified charitable distributions out of retirement accounts, and then we do get a bump up next year on contribution limits, and I can't think off the top of my head what that is. It was like $500.
It increased. Yeah, I have it over there.
Increase HSA things like that. So
everything's got reset higher because of COLA cost of living adjustments, so things get higher.
Yeah,
that's what it is.
Yeah, so that's good, and then. Some of the provisions within the Secure Act 2.0 are taking effect, like the Roth 401k matching and things like that. So some good things from a planning perspective that are going on.
And also too, for the Ohio 529, part of that 2.0 was hey folks, if you don't use all of your money from the cash balance from the 529, you can now use that into an individual Roth account. So you can convert it up to $7,000 for 2024 as a max. You can contribute to an IRA or a Roth for 2024 is $7,000.
Yeah, there's some rules.
Rules, correct. Yeah, there's rules for that. But the fine print, 15 years, you have to have it open as one of them. But whatever.
Crazy.
Good. No, so there's always things going on there.
Buckeyes, big game.
Big game. Oh man, how do I have all these Michigan friends?
It's good. It's a good day to go shopping, right?
Yeah.
If you go out,
they're all loud and proud because it's Michigan against everyone because of Harbaugh. Way to go, Harbaugh. Anyways, So we got that going on. A little quick chart too, just to zoom in on. So this is private schools versus homeschooling. So you can see the bump up there. During COVID went up, a lot of homeschool increase. Upshot is a 51% increase for homeschool, private school up 7%, public school down 4%, just overall enrollment numbers and participation. So again, just sort of follow the money and the preference that students, parents, I should say, have for alternatives to public schools per se. There's plenty of reasons behind that. Oh, Argentina. They got a new elector there. Miller guy, whatever.
Yeah.
So that's great. He wants to slash spending and rescue the fiscal responsibility.
Yeah, he's a free market guy.
Yeah. And Argentina's had inflation over 100% for a while.
That's crazy.
So let's just say there's hope for America, folks. So we the people. That's 2024. Us too could turn the page. So, I guess a couple tips of the month. You want to get into that?
Sure.
All right. So let's see. I guess what have you heard? Remember some other sites that we've used for data gathering?
Oh, like budgeting and all
that?
Budgeting,
yeah. What was that company called?
Mint?
Yeah, Mint.
Oh,
Mint. So what happened to it?
Yeah, it went out of business, or they're closing
up
shop.
Closed up shop. Yeah. So Intuit, bottom out, but then they had 20 million customers. It went down to like 3 million, a little over 3 million, and now they just shut shop. So,
I know. There's some concern with that. Like, what if I have an account at Mint and I have all my data?
Yeah.
There, and they shut it. Like, what happens to all that
data? Exactly. It's mined.
Yeah. And you think too, people didn't want to pay. Did I pay a subscription and I think Mint was free.
There are parts of it. They had some you can do
aggregation, all that you had to pay maybe for.
Yeah, there was some was free and some they had to pay for. But yeah, I hear you. But I thought that was interesting. The other little tips of the month here is I'm just going back to retail sales. So retail sales going back in Q4 1999. So Q4 1999, retail sales made up 0.6 of a percent, so less than a percent of e-commerce. Q2 of 2020, the height of COVID, it jumped up to 16.5%. Again, e-commerce retail, okay, it was 16.5. That was a high watermark. And today, fourth quarter of 2023, it's 15.6. So as more and more people, that's why we have those, Pro Logistics, those data warehouse centers all around, Greater Columbus, et cetera.
Yeah.
It's just in time. So boom, order sitting there, boom, out the door next day, delivery. So you'll expect that number to get closer to 20% or so over the next few years. But I thought that was interesting, just to put things in perspective, historic wise, of e-commerce.
Yeah, I ordered some on Amazon and said, you can have it. I think the delivery time is like 3 a.m. to like 5. Like they give you this window.
Yeah. Oh, jeez.
Like some guy like on my porch at 3 a.m.
That's crazy.
Here's your gummy bears or whatever.
Exactly.
All right, great.
Yeah. New home builds. So good news here. It's been an interesting market for the home builders, but price cuts. So the average price cut right now, it just came out as about 6%. So they're trying to lower the prices to stimulate new home sales. It's been challenging, and plus, lack of supply and all that. And also they're buying down rates too. So that's a big thing, buying down the mortgage rate, from 8 to 4.5 or whatever. So they're trying to make it more affordable for people to get into it. So that's they're playing that playbook again, like they did back in 08, 9, 10, what have you. And then last here I have is this, just as a PSA, public service announcement, energy. So go to the website, folks who need to, energychoice.ohio.gov. energychoice.ohio.gov. So there you can lock in your electric or natural gas rates. And thank God I did when we talked about this this past summer. I remember my rate went to, it's double. So it was like 12, 13 cents per kilowatt hour. And I locked it at 6 cents. So that's for 36 months. So the most you can lock it in is for 3 years, 36 months. And then also, lock in a low rate. So with the rates and volatility and what's coming on, so it never hurts just to project and lock it in for as long as you can at a reasonable rate.
Is that electric?
Electric, yeah, 6 cents.
AUP?
No, AEP, yeah, it doesn't matter who you have. Okay. AEP or what's the thing out north? Ohio Edison.
Toledo Edison.
Yeah, all that. It doesn't matter. It's just all about the kilowatt per hour. So yeah, it's a refresher. So I actually had clients who emailed me after I did that in June. Thank you, Eric. So they saved money locked in. So just another reminder heading into winter season. So that natty gas prices and all that as well. So keep that in I know that natural gas. Yeah, it's been interesting for sure. So anything else top of mind on tips of the month before I head into our favorite charts? Okay, folks, we'll have fun with some of these, but these are some most recent charts hot off the press as of today, 11/20. So again, pullbacks, talk about pullbacks for the S&P 500. 5% pullback on average happens 4.6 times a year. We're now up to 3. So we've had 3 pullbacks of 5%. That's on the S&P. This is valuation. So I brought this back out just to show where we're at. Today is in the dark blue square there mode versus 1 year ago is the red spot. So, whether it's PE, price to book, price to sales, price to cash flow, and dividend, everything today is higher and elevated than a year ago today. So we're still, things are still lofty in certain parts of it, but yes, have come back from the all-time loftiness. I thought that's just a nice little check-in chart visual. Stock market volatility, okay, it's spiked up to 25, hit 24, 25 almost about 3 weeks ago, and then boom, straight down. You can see it goes straight down from that 425 down to 13.8 as of yesterday. So that's the VIX. The average is 18.5, and right now it's ultra snooze mode because it had a rally of 3 weeks here. Bond market volatility. This is the same VIX for the equities. The bond, which is called the MOVE Index. Again, it's at 113 right now, and it's pulled back some of late, but you can see the spike up it had as well just 3 weeks ago, straight up. So again, the average is 85. Right now, it's 113 on the bond market MOVE Index. S&P earnings growth rate ticked back up a little bit, still negative 0.3, but the historical average is 7.7. So we'll see. And as the things fall out, the first quarter is going to slow. We see that turning back over and curling back down. Interest rates, the 2-year, 10-year. So we had that spike up and then boom, straight down. So rates on the 2-year, 10-year is now 4.88. For the 2-year, 10-year is 4.22. Again, still inverted. The inverted means the short end of the yield curve is providing higher rate and yield than the long end. So it's still inverted, which leads to, historically speaking, a recession. In this next page, you'll see the 2-year, 10-year minus. Recessions are graded, or columns are graded, or shaded in gray there. So right now it's 44 bips, 44 basis points. It's almost 0.5%. Now the point is typically you want this to be uninverted. Once you uninvert, you go right into a recession. So we tried to get uninverted, then we turned around, went back down. So we'll see if it goes back up again. But again, still to become over the next few months here as far as when all this officially posts into tougher times. Federal Reserve balance sheet, some good news. So the tightening, and you talked about that on the back end. So yeah, it's 7.8 trillion. So it's come off the high of 9 trillion. So that's good news. So at least we're coming back down. That's just the balance sheet to run off. So the Fed's just not buying any more mortgage-backed securities or anything like that. Just letting assets run off the balance sheet. So that's now down to 7.8 trillion from 9 trillion. Leading economic indicators, okay, still negative, 7.8. So you can see the recessionary. When it's negative, it leads to recession. So, there's plenty of news out there showing, hey, folks, it's still challenging. And then this is the same thing. The leading leading economic indicators on top of the yield curve, the 2-year, 10-year inversions. Remember we talked about the 0.44. The spread is now 0.44, and then the LEI. So again, they're just showing 2 and 1 versus the other prior charts. I had them individually broken out. Unemployment rate, part of the Fed's mandate is they want to see PCE at 2%, the PCE at 2%, and then also unemployment, they want that to go higher. Well, they're getting their wish. So it has now ticked up. So they're starting to get that little curl. So that's part of the Fed's mandate. Payroll gains, okay, that's slowing down. That's all part of the plan. So they want that to continue to go down as well. CPI, we hit that print last month. Okay, great. Yeah, it went down to 3.2 from 9%. Okay, so it's going down in the right direction. That's good. But again, what the Fed really watches, the next chart is the PCE. So the PCE is basically the Fed's primary go-to rate. And basically they want 2%, and that's on the core. So the core right now is 3.7. So far away from the 2% that they want on the core PCE. So yes, it has come down, but still elevated. So we'll see if they have any more work to go, or chopping wood on that, or just stay on pause for longer. And we'll see on the rates. They mentioned how possibly they may these markets are crazy. Now they're anticipating like a 43% rate cut in May of next year. So that'd be interesting to see if it happens that soon. I think it's going to be hold longer than that. It might be summertime is what I'm sort of feeling out, but thinking and hearing. But we'll see how the markets are always trying to. They want their cowbell. It's called cowbell. Ding, ding, ding. Easy money, free money. That's called cowbell. So last year, the personal savings.
Cowbell.
We need more cowbell. Personal savings rate. So you can just sort of see how it's all, COVID money over 20% plus. 32 was the high. Went down to 4% right now. It's 3.4. You can see that little spike up. That's all the free money there over the past year and a half or so, and then it's come straight back down. So the average is 6.3 right now. The personal savings rate is 3.4. We ending on just a few things here. The credit card debt over 1 trillion. People are revolving more. 51% of people are revolving more credit cards. So that's challenging too. Student loan debt repayment started back up. I already had 2 or 3 clients. We had meetings over the past few weeks here, and basically they had a pot of money and they're just paying it all off. Why pay the higher rates? So we're going through that. So that's less money that people have per se. So again, a lot of ebb and flow challenges that are out there. So,
sure.
All righty, folks. You know where to reach us. Please reach out, call us, email us directly, hit our like our YouTube podcast there. That'd be great. And then enjoy the holidays. Yes. Be blessed. Yeah, we're blessed for what we have, even with all the craziness going on. So we're fortunate to have you and part of our lives as well, and our family. So that's
right.
Yep. You hang in there, enjoy it, and we'll talk again soon.
All right. See you guys.
Bye.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment offered through Stratus Wealth Advisors, LLC, a registered investment advisor. Stratus Wealth Advisors, LLC, and True North Wealth Partners are separate entities. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. True North Wealth Partners and Stratus Wealth Advisors do not make any guarantee or other promise as to any results that may be obtained from this. Investing involves risk, including loss of principal.